Hello and welcome subscribers to the Saturday Summary for March 29th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Ibel of Brokers Alliance and Outlook Advisors, here for the biz. Now, as always, let's start with a review of the week. This was the worst week for the NASDAQ Composite Index since October of 2012, with a weekly loss of over 2.8%. Adding to the small cap stock pain was the Russell 2000, posting a weekly loss of over 3.5%. Now, the Dow Jones and the S&P 500 indexes fared slightly better, with a weekly performance of plus 0.12% for the Dow and a negative 0.48% loss for the S&P 500. Now, as we approach the end of the first quarter, we're seeing that same flat performance since the start of 2014. These markets have gone nowhere and continue to bounce up and down within a tight range every day. Now, looking at year-to-date results, the U.S. index winner as we approach the end of the first quarter is the S&P 500 with a stunning year-to-date performance of plus 0.5%. Now, what's driving this train to nowhere, at least so far? Well, it's not economic news, which, while not stellar this week, hasn't been terrible either. In fact, Wall Street pundits credited good news with Tuesday's and Friday's gains in the S&P 500. It's not the Ukrainian-Crimean crisis, which is not improving, but Wall Street pundits tell us that unless a shooting war breaks out, that the situation is already priced in for stocks. So perhaps it's the fear that the Federal Reserve really is going to take the punch bowl away from the party in 2014. With the continued decrease in stimulus that has already allowed these investment banks to borrow at zero rates for years using stimulus money reserves as collateral. Now, these charts right here show the direct correlation to the rise of the S&P 500 index since 2008 as increasing rounds of Federal Reserve stimulus. Now, note that when each phase of the stimulus ended, the S&P 500 declined and then increased again with each new round of stimulus. But I don't know, they keep telling us the market is strong based upon fundamentals. Anyway, moving on, I want to devote the rest of my time to this article published this week called "Could the Markets Crash Again?" It's written by Graham Summers of Phoenix Capital Research. It was published this week. By the way, it's on page 5 of the written summary. Now, Mr. Summers brings to your attention a growing threat to the markets, the sort that our typical retail client can't really see coming. And this is the $600 trillion derivatives market. Yes, you heard that right, $600 trillion. Now, before going on and talking about that, let's put that number in perspective. The 2012 gross domestic product for the entire world was only $71.6 trillion. Thus, this global derivatives market is worth about 800% of the entire world's GDP. Now, in the article, the author points out that about 80% of the collateral backing these various derivatives, credit default swaps and things like that, are government bonds. That's US bonds, German bonds, Japanese bonds, etc. Now, Mr. Summers writes that, so, what happens when the current bond bubble bursts and we begin to see bonds falling and yields rising? Another collateral scramble begins, this time with a significant portion of the interest rate derivative market just blowing up. At that point, rising yields is the last thing we need to worry about. The assets backstopping this $600 trillion market themselves will be falling in value, which means that the real crisis, the crisis to which 2008 was simply a warm-up, will be upon us. And this is why central banks are so committed to keeping rates low. This is why all central bank policy has largely benefited the largest financial institutions, as opposed to Main Street, because the central banks aren't trying to grow the economy, says Mr. Summers. They're trying to prop up the financial institutions' derivative trades. So, what is a derivative? Well, simply put, it's an asset whose value is directly or indirectly linked to the value of another asset. In even simpler terms, it's a wager. This is how large institutions make lots of money, by buying and selling derivative bets to each other. Now, when it works, it's highly profitable, but when it doesn't, it can be disastrous. Now, let's use a simple but effective analogy to get our arms around this: the casino. Now, Wall Street is often referred to as a casino, conjuring up images of roulette tables and the like, but the analogy for the derivatives market is actually the sports book, where bets are made upon the outcome of sporting events. Now, when two teams are playing a game of, say, football, there are really only two parties who have a direct interest in the outcome of the game, the two teams that are playing. Team A and Team B. Now, in the casino sports book, however, a person without direct interest in the game can place a bet not only on which team will win, but also on an almost endless multitude of other outcomes, such as which team will score the first touchdown, which team will be in the lead at halftime, and of course, who will win by what's called the spread of the final score. Now, if Team A wins the game, but by fewer points than the spread, then even though someone may have bet on Team A to win, they may not win the bet, okay? But if Team A wins that game and basically by more points than beating the spread, then that person, of course, betting on Team A would collect on their bet. So in simple terms, this is how the derivatives market works, albeit that the dollars are much, much larger, and of course the mathematical calculations are much more complex. Now, for example, let's say Bank A owns a mortgage bond. Now, in this instance, Bank A is the only party with a direct interest in the performance of that bond. Think of that as the football game. However, in the derivatives sports book, Bank B can make a bet on whether or not the bond owned by Bank A will rise or fall in value, okay, based upon some sort of spread, typically an interest rate move. Now, who does Bank B make that bet with? Well, actually, Bank A, who owns the bond, might take it. Or perhaps Bank C, okay? Or Bank B. Now, Banks B and C also own similar bonds, so they may make similar bets regarding their bonds with each other as well, including Bank A. I know it's confusing, okay? Now, some types of these bets are called credit default swaps, in which Bank A pays money, premium, to Bank B for insurance against their bond losing value. Now, this premium is paid to Bank B. But because Bank B is not required to actually put any money aside, okay, it's all profit to Bank B. However, Bank B may have to put up some collateral, sovereign bonds, back to Mr. Summers' arguments, okay? Now, as we take this all the way through, imagine hundreds of institutions with thousands of these various types of bets with each other. And now you see the $600 trillion derivatives markets. So, who cares, right? It's perfectly legal, and frankly, it isn't really even regulated. Now, you should care, because when the conditions upon which these bets are placed go negative, such as interest rates rising rapidly, then all these banks want to collect on their bets, but they are also losing bets at the same time. Simply put, all these players are bankrupt simultaneously, and they can't pay each other, causing a domino effect across the entire global financial system. Now, in a rush to raise capital, they sell assets such as stocks, bonds, etc., and the value of the average person's stock holdings crashes along with the shares of those held by the banks. They call this a liquidity crisis. Okay? This is exactly what caused the financial crisis in 07 and 08. As a small percentage of mortgage loans went delinquent, it triggered the payoff of all these bets. And thus, Mr. Summers' warnings in his article, "Can the Markets Crash Again?" Because this derivatives market is larger now than it was in 2007 and 2008. Now, this is an example of why we tell clients that it's okay to have money in the stock markets as long as you understand that you're along for the ride and that your money is subject to what the big boys decide to do. It's also why we advise our clients to keep some money off the table in guaranteed vehicles. Well, that's all I have time for today, but be sure and check the written summary for more information. There are at least 8 really good articles plus the quotes of the week in there. Now, if you want to see something covered in the summary or just have comments, contact me at the email address scrolling on the bottom of your video player. If you want a better quality of life and annuity support in your practice, more than just products, contact us at Brokers Alliance. That's your Saturday summary for Saturday, March 29th of 2014. As always, thank you for joining us, and we look forward to seeing you next Saturday. Have a great weekend.